What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today we're going to revisit retirement plans, those that are available to W-2 employees, or just individuals, and those of you that own your own business. So all the numbers we use in here will be the 2024 numbers because this recording will air in 2024. So let's get started. So the first group of retirement plans, which most people are probably familiar with, are your 401k plans. If you're a teacher or a public employee, this might also be referred to as a 403b. So these are retirement plans that allow you to contribute as an employee up to $23,000 a year. Now, if you're age 50 or older, you get an additional contribution of $7,500. It's called a catch-up contribution. So for the total for employee deferrals in 2024 is $30,500. In addition, the employer can make a contribution. Now, this is going to be based on a percentage of W-2 wages. It's 25%. That contribution can bring the total up to $69,000 for those under 50. If you include the $7,500 catch-up, the total could be $76,500. So that's your 401k plan contributions. Those same numbers apply if it's a solo K, if you're self-employed and have a 401k plan in your business. Next, we have a simple IRA. So this is a type of IRA plan that allows the employees to contribute up to $16,000 a year. The catch-up contribution for those age 50 and over allows for another $3,500 per year. So that would be a total of $19,500 in employee deferrals. There's also an employer matching component, generally 2 or 3%, depending on how they design the plan. That will be in addition to the employee contributions. Next, we have the IRA. So this is your traditional IRA, your Roth IRA for individuals, I should say, individual IRAs. The contribution limit in 2024 for your IRAs and Roth IRAs, $7,000. There is a catch-up contribution allowed for those age 50 or older of an additional $1,000. So we have a total of $8,000 possible contribution in 2024. Now, there are some income limitations that come with the IRAs in certain circumstances. We'll touch on those here shortly. The SEP IRA, this is going to be for business owners, or if you're an employee at a business that has a SEP IRA in place, this may apply to you as well. So the SEP IRA is funded entirely by employer contributions. So it's going to be 25% of the employee's compensation. There is a cap on that, $69,000 for 2024. So those are the main plans most people are familiar with. So let's go back to the individual IRAs, the individual accounts, the IRAs, traditional, and talk about some of those limitations. So the limitations for a traditional IRA when it comes to income are that what we're talking about in this case is it's not necessarily whether or not you can make it, it's whether it's tax deductible. And the circumstances that apply that may change this are whether you're covered at a plan at work or if your spouse is covered by a plan at work, if you're married. If not, generally, your contribution is going to be fully deductible. So if you are covered by a plan at work and your filing status is single or head of household, and your income is $77,000 or less, you can take the full contribution. Then it starts to phase out. So between $77,000 and $87,000, you get a partial deduction. At $87,000 or more, there's no deduction, but you can make non-deductible IRA contributions. And that will establish a basis in your retirement account. So when you take it out later, then a portion of your withdrawal in retirement is coming out tax-free. If you're covered by a plan at work and you're married, then you get the full deduction for the traditional IRA if your income is under $123,000. The phase out is between $123,000 and $143,000, where you get a partial deduction. When your income's over that $143,000 limitation, then there's no deduction. You're going to only be able to make non-deductible contributions. So this would apply if you have a W-2 job and say you're covered by a 401k plan, but you also wanted to put money into a traditional IRA. That's when these income limitations come into play. Now, if you're not covered by a retirement plan at work, this changes a little bit. So if you're single or head of household, not covered by a plan at work, you get the full contribution. There's no income limitation. And if you're married filing jointly and neither you or your spouse are covered by an employer plan, you also get the full deduction for your contribution. Now, if you're married and let's say you're not covered by a plan at work, but your spouse is, now we have income limitations that come into play. And these income limitations, they're a bit different, but they do coincide with the income limitations for a Roth contribution. So if you're married filing jointly and your spouse is covered by a plan, if your joint income is $230,000 or less, you get a full deduction for your traditional IRA contribution. If your income is between $230,000 and $240,000, there's a partial deduction. And once you're over $240,000, there's no deduction allowed for your traditional IRA contributions. Now, let's move on to the Roth IRA. So Roth IRAs they're not tax deductible, but your contributions go in after tax. And then they come out tax-free, including all the earnings, as long as you've had the account open for at least 5 years and you're of retirement age, so over 59 and a half. Your contributions come out tax-free at any time, but then your earnings also come out tax-free once you've had the account open for 5 years and hit age 59 and a half. Now, there are income limitations for a Roth IRA, and they happen to be what we just talked about with a traditional IRA, where one spouse is working. So if you're married filing joint, then and your income's under $230,000, you can make a Roth contribution with no limitation. If you're between $230,000 and $240,000, it's going to be a partial deduction. And then at $240,000, it's totally phased out. No Roth contribution is available. Now there's a workaround we're going to talk about here in a second. If you're single, those income limitations are for a Roth IRA. There are income limitations even if you're single here. Under $146,000, you can make the Roth contribution. If you make between $146,000 and $161,000, then it's a partial contribution, and greater than $161,000, there is no Roth deduction allowed, going the normal contribution method. Now, a workaround when your income's too high for a Roth contribution, this is often referred to as a backdoor Roth contribution. What you can do is make a non-deductible contribution to your traditional IRA and then convert that to a Roth. So you make this non-deductible traditional IRA contribution and then convert it to Roth. Now, the key is here, if you have an existing traditional IRA, whether it's a traditional IRA or a SEP IRA, you have tax-deferred dollars in some type of IRA account, you have to convert that first before you can do the backdoor Roth. So make sure you are aware what kind of accounts you have out there, because you don't want to get tripped up and do something wrong and have to make a correction. Now, with the majority of these retirement plans we're talking about, 401ks and IRAs, there is something called a required minimum distribution when you hit a certain retirement age. So the IRS requires you to start taking money out because let's say they want to receive the taxes that are owed on that. You put money in tax deferred and it comes out, it's taxable. The exception here being a Roth, there's no RMD because it's going in tax free, or it's going in after tax. Taxes have already been paid on that money and it's going to come out tax free. So the IRS doesn't care as much. So if your money went in pre-tax, it's going to be taxable when it's distributed. And when you hit a certain age, you have to start taking withdrawals. Now, this is based on your date of birth. So anyone born before July 1st, 1949, their RMD age was 70 and a half. Between July 1, 1949 and December 31st, 1950, then the RMD age is 72. And with the latest Secure Act 2.0, they changed it again. Now, anyone born between January 1, 51 and December 31st, 1959, their RMD age is 73. Born after 1960, the RMD increases again to the age of 75. At some point, you have to start taking the money out. because the IRS, like I said, they want the tax money on that. Now, one thing you can do when you're old enough to reduce the tax hit on your RMDs is make a qualified charitable distribution from your IRA. So QCDs for short. These can satisfy the RMD requirement. You can make charitable distributions. They have to be made directly from your IRA of up to $100,000. Now, there's certain rules. You have to be at least 70 and a half years old. But this is generally better than making a IRA or a charitable contribution on Schedule A, because taking it from your IRA reduces the taxable amount of your IRA, which reduces your AGI. And your AGI can determine other deduction limits. For example, medical expenses are based on 7.5% of AGI. So reducing your AGI is better than just taking the deduction on Schedule A, because it opens up the opportunities for other deductions, and certain things are limited based on income. So you want to reduce your AGI where you can, and QCDs do just that. That about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review, hit that like and subscribe button. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's THEPULICEGROUP.com/contact.